you're a home buyer, somebody or a young person looking to buy a home, you need a bit of a reset.
There is a possibility on the other side of this that inflation could actually be quite low.
We're currently experiencing one of the most brutal mortgage recessions in the history of the US, going back past the GFC into the 1990s. The mortgage business currently is absolutely dead. Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and today we're going to take a look at the data that is suggesting that we are experiencing recession right now in the mortgage industry. And not just any recession, one of the worst recessions in the mortgage industry in the history of the US. And I can tell you guys, as a loan officer of over 20 years, the business is absolutely dead. Applications are in the gutter, going again back to 1995. So we hear a lot of narratives like, oh, buying demand has come back, buying demand has come back. And although in some areas it has, right ahead of spring home buying season, that still doesn't compare to what it is normally. The only reason it feels like all these home buyers are coming back is we still have limited inventory. And so just as long as the metro areas that we're tracking are increasing in inventory, everything should kind of be okay. And also, as long as you're not purchasing with your emotion, you want to purchase with fundamentals. But regardless, you guys, again, the company that I was working for 10 years, right after I stepped down, or right about 2 months after I stepped down, is no longer in business, and they went through the GFC. These mortgage companies, I'm telling you guys right now, they put the cart before the horse, which means they basically make so much profit, non-depository mortgage companies, they make so much profit up front that they have enormous overhead. So if these mortgage companies have 2-3 bad months, and then on top of that experience chargebacks or EPOs and early payoffs, you guys, it takes 3-4 months for them to completely go bankrupt. It is an absolute disaster. And again, I ran a P&L for 3 branches. The expenses are overwhelming. And so we're going to see going into 2024, even more mortgage companies go out of business. And if you guys find value in this video, please like it. It helps out the channel a lot. And don't forget, you guys, hit notifications, share this, and comment below. Some of the comments are hysterical. Also, warning, if you're getting triggered by Johnny I Fly, he's doing it on purpose. I love that guy. He's messing with you. Don't get triggered. It's just Johnny Fly. All right. Anyways, moving on. Today's headline is coming from fastcompany.com, titled, "The housing market is in the middle of one of the most brutal mortgage recessions in history." And they also go on, "The good news, question mark, this mortgage recession may have finally hit the bottom, at least in terms of volume." At least they're hoping. Am I right? The bad news for the mortgage industry: the mortgage market is still passing through one of its biggest slumps in recent memory because buying demand is crushed, you guys, not just because interest rates, because of prices. I'll show you that data later. The good news: there are signs that this mortgage recession may have finally hit the bottom in terms of volume. And I'm curious what those signs are, since the week over week and month over month data is down. I'm very curious. This story is pretty simple. After spiking in 2022, mortgage rates still haven't come down in a meaningful way. That has constrained turnover in the market for existing homes, as the switching cost on going from a 3% mortgage rate to a 6 or 7% mortgage rate doesn't make a lot of financial sense for would-be sellers. Additionally, traditional refinancing has essentially dried up. And this is really, really crazy, guys. This is Mortgage Purchase Application Index, and you see, I mean, this is low, and this goes back all the way to the year 2000. And I really want to point out that this is even lower than the GFC. There was more people purchasing real estate during the great financial crisis than right now. Think about what I'm saying. The business is slower right now versus the GFC. And we had massive credit restrictions. We had the Dodd-Frank Wall Street Reform and Consumer Protection Act. No one knew what to do when they were changing laws during the GFC, and business is worse right now. I wonder what happens when they unlock the housing market, lower rates, and all the people on the sideline that wanted to sell, sell. Oh, it looks like it flipped a little bit, guys. I'm sorry. Well, actually, unless if you go to today's information, but regardless, according to the latest reading this week from the Mortgage Bankers Association, both mortgage purchase applications and refinance applications have bounced up just barely, but from their lows reached in 2023. And this is the bounce up right here in mortgage purchase applications. So little tiny baby bounce up. And here's the refinances. I mean, is that really, I mean, is that a bounce up? I mean, you see the reckless optimism. I mean, it nudged up. It nudged up slightly. But again, going back to 2000, I mean, no one wants to, why would you refinance from a 3% to 6%? The only reason you would do that is basically to cash out. Or, I mean, that's really the only reason, obviously divorce and things like that, but it's cash out. That's the only thing that maybe makes sense. Suppressed mortgage activity means that there are still waves of layoffs and mergers occurring across the mortgage industry. If you want to look at the layoffs for mortgage, you can hit this tracker right here if you're interested in looking at that. But let's keep going on this article, you guys. Combined quarterly revenues of 3 major publicly traded U.S. mortgage firms. So that's obviously Mr. Cooper, UWM Holdings, and Rocket Company. So you see the spike up. I mean, geez Louise. Obviously, this was the lockdown, so that makes sense. But look at this spike up. I mean, they're hiring. Let's hire. We need more people, more underwriters, more processors. We need all these people. And then, oh, just kidding. We need to lay all of them off. I mean, it's in the gutter. It's still higher than what I would have thought. But it's still, regardless, you guys, this is in the absolute trash can. And they need to make more money because they're experiencing inflation as well. When we talk about the mortgage market, we aren't referring to the entire housing sector. For instance, on a national level, single-family home prices rose in 2023, and according to Redfin, that rose about 4%. And all things considered, the home builder sector has been fairly resilient, which is not accurate. Home prices are down massively, and they aren't properly reporting seller concessions. That whole story is going to roll out still. Okay, they haven't even popped that we're aware of yet for some of the stuff that they're doing. But regardless, have been fairly resilient despite the mortgage rate shock. Builders have reduced their margins to offer incentives like mortgage buydowns, while the inventory on existing homes remained tight, and so builders were able to keep selling. And another thing, guys, you know, most of those builders have their own mortgage companies. So these new home builders are destroying the mortgage industry as well. As a loan officer, I used to always lose businesses to builders. So if I had a client and I approved them for a mortgage and they went shopping for a new home, I would constantly lose them because I can't compete with the incentives that their lenders are offering. Like, for example, some of them, like Lennar, is offering a 4.25 30-year fixed. The mortgage rates are 7.25. That's a rate 3 points, 3% under prime. That would cost me like $30,000. We don't have $30,000 in profit, so we get destroyed. Lenders, loan officers outside of new home builders get absolutely annihilated. In the sense, that's where a lot of the business is being conducted, depending on your metro area. It kills you. So what do you think is happening in Houston? We're heavy on new construction. It hurts in Houston. People are suffering in my own market. If you're a loan officer, you can feel it right now. Big picture, the primary way the mortgage industry could rebound in the short term is obviously if mortgage rates were to see a steep decline. And they say steep decline because they need refinances, right? People aren't going to refinance unless the rates are lower. An improved level of housing affordability would not only spur more activity in the existing home market, but it would also unleash some pent-up demand in the refinance segment. And what they mean there, guys, is the people that were dating the rate that are now locked into an abusive, toxic relationship with the interest rate that they thought that they could refinance out of. But they're coming to find that they cannot refinance out of it, not yet. Anyways, until there is some type of economic turmoil. Obviously, we're not going to hit the 2% inflation goal, right? We're not. How can we hit the 2% inflation goal without an economic turmoil or some type of credit event? How can we possibly do that? Anytime they mention rate cuts, the whole market blows up. Runaway inflation, sentiment is strong. Sentiment is strong. So they got to keep boiling the frog alive. And that's what I believe is happening. Let's go over some of the reasons why mortgage is such in the gutter right now. This is our Fred Economic Data 30-year fixed rate mortgage. Now, one of the reasons why, guys, it's not necessarily that rates are high right now. It's the trajectory of the rate increases. So when I take us back to 2018, I mean, this whole time, you guys, interest rates remained in the 3 to 4%. So the entire affordability of the housing market is 3 and 4%. We can't have 3 and 4% right now. We have 3 and 4% right now. The house market's going to blow up until it just completely implodes forever. But the reason is this trajectory. We went from 3% rates at the beginning, basically the beginning of 2022, all the way straight up to the 7% in that same year. So we had more than a double up in 1 year. That's called payment shock. The entire industry got shocked by that. And look at this. Just when the industry thought, oh, it's going down. Just kidding. Inflation is still here. Boom, ratchets back up, plummets back down because of reckless optimism. And now we're sustained in the mid to high 6% ranges to the low 7% ranges. So you can't refinance into these rates because the only people that purchased above that are these people. So the people that purchased in that 3-month period 6 months ago, they don't have any equity. They can't refinance. Now, this is another reason why the business is dead. This is the housing inventory active unit count. This is Fred. This calculates it differently. Now, this is where we need to be. Okay, so we need about 1.2 to 1 million active units. Despite what you hear about us needing 4 million, we don't need 4 million active units. Okay, we need another 300,000. That's it. Just 300,000. Now, right now we're sitting at 714. That's low. And that's one of the reasons, again, why the business is dead. But I do want to basically point out we're up. All right. We're up, especially when we look at the low here in February of 2022. We have more than double the inventory that we had at the start of 2022. Again, double the inventory. All right. More than double the inventory. So it is improving, but unaffordability is not improving. Inventory is, unaffordability isn't. And it's not just because of the interest rates, it's because of the prices as well. And for the people that don't understand what we're talking about when we're talking about bubble, let's look at the GFC bubble, looking at 2002. Here's that bubble right there. This was a long, drawn out asset bubble. And again, for the people that don't know what we're talking about when we're talking about bubble, it's this little thing right here. Do you guys see that massive bubble right there? And this was the deflation. This is when we were seeing home prices go down. People can't fathom home prices going down. There you go, Dave Ramsey. Here's another time in history where home prices went down, starting according to this in Q4 of 2022. So, home prices actually did go down, but the bubble, all right, this massive equity run-up destroyed us because wages didn't keep up. Wages can't keep up like that. We need steady growth. Like here you see more steady growth right here. It was a little bit bubbly right here, kind of balanced out. And then boom, destroyed us, killed the business, killed the American dream of home ownership, and absolutely put the entire world in a very bad unaffordability dilemma. Now, another thing that I didn't cover, AI. Now, I'm not as worried about AI replacing loan officers as I am about it replacing realtors. A loan officer, in my opinion, don't get mad at me, has a lot more responsibility than a realtor because of how uncertain the industry is. As far as the regulations constantly changing, you have different individuals. But I will say one of the things that I do love about being a loan officer is it gives me the ability to really peer into a consumer's financial situation. Whereas a realtor, you're really negotiating and touring houses. A loan officer can really dig in like the health of the consumer. So I like that part, but regardless, the industry is getting shaking up. So not only do we have this whole thing with mortgages and loan officers going out of business and companies going out of business, don't forget, you guys, realtors are under attack as well. I don't see how NAR, National Association of Realtors, can survive the lawsuits, as well as like the big brokers like KW, RE/MAX. A lot of these people are suffering. But anyways, guys, do me a favor, comment below. Let me know how you think this whole thing is going to shake out. Do you think it's going to be a quick rebound? Are they just going to magically lower interest rates? How and what situation would they lower interest? But anyways, guys, other than that, I really hope you guys got some new value, insights, and perspective. And if you're out there investing in real estate, you already know I wish you luck, and I hope you win.